The billionaire behaviors that most people wouldn't believe are not about grand risky bets or emotional genius. They are about the cold, hard, and relentless application of logic data and a profound understanding of probability. It is a world where the human element, the very thing most people rely on, is the single greatest liability. We are going to explore 5 of these principles, the quiet, almost invisible behaviors that separate those who succeed systematically from those who succeed by accident. The first principle is the absolute rejection of intuition. For most of human history, intuition has been a survival mechanism. It tells you to run from the shadow in the bush. It tells you who to trust in a negotiation. But in the modern world of complex systems, in markets, in business, in any field where data is abundant, intuition is a dangerous relic. It is a shortcut that leads to a dead end. When I first started in this business, I saw brilliant minds fail because they overlooked one simple truth. Their minds were designed for pattern recognition in a low data environment, not for the high-dimensional complexity of global finance. They would see a stock price drop, and their intuition would scream, buy the dip or sell before it crashes. But what is that intuition based on? A handful of past experiences, a news headline, a feeling in the pit of their stomach. It is a narrative, not a calculation. The human mind is a magnificent storyteller. It constantly seeks to impose order on chaos to find a simple, satisfying cause and effect narrative for every event. This is what we call the narrative fallacy. A company's stock price goes up and the news media immediately invents a story. The CEO's new strategy is paying off, or the market is finally recognizing the value. This story is comforting, but it is almost always a simplification, a lie we tell ourselves to feel in control. The reality is that the price movement is likely the result of 1,000 small, uncorrelated factors, none of which can be easily summarized in a headline. Consider the common mistake of buying a stock simply because you like the company's product. Your intuition tells you, I love this phone, so the company must be a good investment. This is a perfect example of the narrative fallacy at work. Your personal emotional experience is being substituted for a rigorous analysis of the company's balance sheet, its competitive landscape, and the statistical probability of its future performance. The model, on the other hand, has no opinion on the phone. It only sees the data, the cash flow, the debt-to-equity ratio, the trading volume, and the correlation of its price movement with other assets. The model is indifferent to the story. It is only interested in the signal. We, on the other hand, built a system that has no stomach. It has no fear. It has no greed. It only has data. Imagine a vast, complex machine that is constantly observing the world. It is not looking at the front page of the newspaper. It is looking at millions of data points. The price of a commodity in one country, the interest rate in another, the volume of trades in a third, and the subtle, almost imperceptible correlations between them. It is looking for tiny temporary inefficiencies that can be exploited. Let me give you an analogy. Think of a casino. The casino does not rely on a single massive win. It relies on the house edge, a tiny mathematical advantage on every single hand of blackjack or spin of the roulette wheel. The individual gambler driven by intuition and hope might win a few hands, but the casino operating on pure, cold probability knows that over 1 million hands, the tiny edge will compound into a massive inevitable profit. Our approach is to be the casino. We do not bet on a single outcome. We identify thousands of these tiny mathematical edges. Each one is so small that a human would dismiss it as noise. But when you execute thousands of these trades every day, and you do it with the precision and discipline of a machine, the noise cancels out and the small, reliable edge emerges as a substantial, predictable return. The billionaire behavior here is the willingness to completely disregard your own human judgment. It is the humility to say, my brain is a beautiful instrument for mathematics, but a terrible instrument for emotional decision-making. It is the discipline to follow the model even when every fiber of your being tells you the model is wrong, because the model is based on millions of data points, and your feeling is based on one anxious moment. The failure of most investors is not a failure of intelligence. It is a failure of character. They cannot separate their ego from their portfolio. They cannot admit that a simple, unemotional algorithm is a better decision maker than they are. The moment you accept that your intuition is a liability, you take the first step toward systematic success. You replace the unreliable narrative of your mind with the unanswerable logic of the numbers. The second principle is the profound power of small edges. Most people are looking for a 10-bagger, a 100-bagger, the one investment that will change their lives overnight. They're looking for the grand slam. This is a fundamentally flawed approach because the grand slam is by definition rare and unpredictable. It is a matter of luck, not system. In our work, we are not interested in predicting the next major market crash or the next revolutionary technology. Those events are too large, too complex, and too infrequent to be reliably modeled. We are interested in the subtle, short-term fluctuations that occur hundreds of times a day. We are looking for the statistical anomaly that lasts for a few minutes or even a few seconds. Think of it like this. If you have a coin that is weighted to come up heads 51% of the time and tails 49% of the time, you would be a fool to bet your entire fortune on a single flip. You might lose. But if you bet a small fixed amount on that coin 1,000,000 times, you are guaranteed to win. The 51% edge is small, almost negligible in a single event, but it is a certainty over a vast number of trials. This is the essence of the small edge. It is not about being right 100% of the time. It is about being right 57% of the time or 52% of the time and executing that advantage with such frequency and scale that the small edge compounds into a massive result. This is a behavior that most people wouldn't believe because it is boring. It lacks the drama of the high-stakes gamble. It is the patient, systematic accumulation of tiny, reliable gains. The true magic of the small edge lies in the compounding effect. Imagine two people saving money. One person finds a way to earn an extra 1% return on their savings every year. The other person does not. In the first year, the difference is negligible. After 10 years, the difference is noticeable. After 50 years, the person with the 1% edge has a fortune that is exponentially larger. The small edge, consistently applied, is the most powerful financial force in the universe. It is the difference between linear growth and exponential growth. To make this simple, consider a non-financial example, a manufacturing process. Most companies focus on a massive, expensive overhaul to achieve a 20% efficiency gain. A systematic thinker, however, looks for 5 separate areas where they can achieve a 1% gain, 1 gain in raw material sourcing, 1 in machine calibration, 1 in logistics, 1 in employee training, and 1 in waste reduction. Each 1% gain is easy to achieve and sustain. But when all 5 are implemented, the total efficiency gain is not 5%. It is compounded, leading to a far more robust and sustainable advantage than the single massive overhaul. The small systematic improvements are less visible, less dramatic, but infinitely more reliable. The challenge is in the execution. A small edge requires a massive infrastructure. You need the computational power to process the data, the mathematical models to identify the edge, and the technological speed to execute the trade before the edge disappears. The edge is fleeting. It is a temporary imbalance in the market, and the market is constantly working to correct itself. If you are too slow, the opportunity is gone. The analogy I often use is that of a river. Most people are trying to build a dam to capture a massive flood. We are simply collecting the water that flows by every second. We have thousands of small buckets, and we are constantly dipping them into the stream. No single bucket is full, but the total volume of water we collect is enormous. This principle extends far beyond finance. In any complex endeavor in science and engineering, in business, people often waste time and resources chasing the one big breakthrough. The truly successful behavior is to focus on the marginal improvements. What is the one small thing you can do today that gives you a 1% advantage? And what is the next 1% advantage you can find tomorrow? The compounding effect of these small systematic improvements is what creates exponential success. It requires a fundamental shift in mindset. You must stop looking for the hero moment and start looking for the process. You must stop celebrating the occasional big win and start celebrating the consistent, disciplined execution of your system. The billionaire behavior is the relentless focus on the process, knowing that the outcome is simply a mathematical consequence of that process. The small edge is the most powerful force in the universe, provided you give it enough time and enough trials to work its magic. The third principle is the absolute necessity of eliminating emotion. This is perhaps the most difficult behavior for a human to adopt, and it is why most people fail. Fear and greed are the two most destructive forces in any system of rational decision-making. They are the viruses that corrupt the data. When the market is rising, greed tells you to invest more, to take on more risk, because you feel like you are missing out. When the market is falling, fear tells you to sell everything, to cut your losses because you feel like the world is ending. Both of these emotions are powerful, primal, and completely irrelevant to the underlying mathematics of the system. The system we built is designed to be perfectly unemotional. It is a mechanical process that executes a trade when the data tells it to, and it exits a trade when the data tells it to. It does not care about the news. It does not care about the talking heads on television. It does not care about the historical significance of a price level. It only cares about the statistical probability of a future movement. The true value of a systematic approach is that it acts as a shield against ourselves. It is a mechanism for enforcing discipline when our own psychology is failing us. The emotional trader is constantly battling stress and anxiety. Every market fluctuation is a personal attack, a source of fear, or a rush of adrenaline. The psychological cost is not only exhausting, but it leads to irrational decisions, buying high and selling low, the classic emotional trap. The systematic approach, by contrast, is calm. The system executes the trade, and the human operator is merely an observer, insulated from the emotional noise. The decision was made weeks ago based on data, not on the morning's headlines. I recall a time when one of our models suggested a massive counterintuitive trade. The market was in a state of panic, and every human instinct, every piece of conventional wisdom screamed to do the opposite. A human trader, even a highly disciplined one, would have hesitated. They would have questioned the model. They would have let fear creep in and paralyze their action. But the system did not hesitate. It executed the trade precisely as designed. The outcome, as the mathematics predicted, was a significant gain. The lesson here is that the system is not just a tool for finding opportunities. It is a shield against ourselves. It is a mechanism for enforcing discipline. The billionaire behavior is the realization that your own psychological makeup is the biggest obstacle to your success. You must build a wall between your feelings and your decisions. This applies to all aspects of life, not just finance. Think about diet, exercise, or learning a new skill. You know logically what you should do. The data supports a consistent, disciplined approach. But then emotion intervenes. You feel tired, so you skip the gym. You feel stressed, so you eat comfort food. You feel overwhelmed, so you abandon the new skill. The feeling, the emotion overrides the logic. The successful behavior is to create a set of rules, a system that you commit to following regardless of how you feel. It is a contract with your future self. The system removes the decision from the moment of temptation. It is the difference between deciding to go to the gym every Monday, Wednesday, and Friday, and deciding at 100 p.m. on Monday whether you feel like going. The latter is a recipe for failure. The former is a system for success. Historically, emotional failure has been the downfall of countless brilliant minds. Think of the Dutch tulip mania or the South Sea bubble. These were not failures of information. The warning signs were there. They were failures of emotional control, where the collective greed of the crowd overwhelmed all rational thought. The systematic thinker looks at these events not as historical curiosities, but as proof that the human mind is fundamentally unsuited for high-stakes, high-frequency decision-making. The tyranny of emotion is subtle. It disguises itself as prudence, as caution, or as a flash of genius. But it is always a deviation from the logical path. The true power of a quantitative approach is not just its ability to find patterns, but its ability to enforce a purely rational response to those patterns. It is the ultimate act of self-control achieved not through willpower, but through automation. The fourth principle is the belief in the unseen language of patterns. Most people see the world as a series of random disconnected events. They see a stock price move up and they attribute it to a news story, a CEO's comment, or a political event. They are looking for a simple linear cause and effect narrative. This is a profound misunderstanding of how complex systems operate. The world, and especially the financial market, is not a collection of independent events. It is a vast interconnected network of feedback loops, subtle correlations, and hidden mathematical structures. The price of a stock is not just a reflection of that company's earnings. It is a reflection of the price of oil, the exchange rate of the yen, the weather in South America, and 1,000 other variables that seem on the surface to be completely unrelated. The billionaire behavior is the ability to see past the surface narrative and decode the underlying mathematical language. We believe that everything is a pattern waiting to be discovered. The movement of a stock is not random. It is a reflection of a temporary predictable structure that can be modeled and exploited. Consider the analogy of weather. A layman looks outside and says, "It's raining because of the clouds." A meteorologist sees a complex system of atmospheric pressure, temperature gradients, humidity levels, and wind patterns, all governed by differential equations. The meteorologist does not predict the weather by looking at a single cloud. They predict it by modeling the entire system. Our work is financial meteorology. We are not looking at the clouds, the news headlines. We are building massive, complex models that look at the entire atmosphere of the global market. We are looking for the subtle, non-obvious correlations. For example, we might find that when the price of a certain commodity moves in a specific way, it has a statistically reliable, short-term impact on the price of a completely unrelated currency 3 hours later. A human would never see this. It is too subtle, too fast, and too counterintuitive. A critical distinction here is between correlation and causation. The human mind is obsessed with causation. We want to know why something happens. But in a complex system, causation is often impossible to isolate, and more importantly, it is unnecessary for prediction. If a model reliably shows that event A is followed by event B 60% of the time, the systematic thinker does not need to know the underlying mechanism. They simply need to exploit the 6% probability. The traditional investor spends their time researching the why, which is often a waste of time. The systematic investor spends their time exploiting the what. The market is a prediction machine, not a philosophy class. This requires a fundamental shift in the definition of knowledge. For most people, knowledge is a collection of facts and narratives. For us, knowledge is a set of reliable predictive models. We don't need to know why the pattern exists. We only need to know that it does exist and that it is statistically reliable. The why is often a distraction, a narrative that appeals to the human desire for a simple story. The what and the how much are the only things that matter. The process of decoding this unseen language is relentless. A model that works today might stop working tomorrow. The market is constantly evolving and the patterns are constantly shifting. This is why our team is not composed of finance experts, but of mathematicians, physicists, and computer scientists. They are experts in pattern recognition, in modeling complex systems, and in the scientific method. They treat the market as a scientific problem to be solved, not a financial problem to be gambled on. Furthermore, the patterns are not static. They are constantly being eroded by the very act of exploiting them. Every time a model executes a trade, it contributes to the market's efficiency, making that specific pattern slightly weaker. This necessitates a constant, rigorous process of model recalibration. We are not looking for a single permanent truth. We are looking for temporary shifting truths. The systematic thinker understands that the work is never finished. It is a continuous, iterative process of observation, modeling, and refinement. The moment you believe you have found the final answer is the moment you begin to fail. The billionaire behavior is the commitment to the scientific method. Observe, hypothesize, test, refine, and repeat. It is the belief that every piece of data, no matter how small or seemingly irrelevant, is a clue in the grand puzzle. It is the understanding that the greatest opportunities are not found in the obvious, but in the subtle hidden structures that only mathematics can reveal. The fifth and final principle is the profound value of a scientific team. Most people believe that success in finance is the result of a single brilliant individual, the lone wolf trader. the visionary CEO. This is another narrative that appeals to the human ego, but it is fundamentally incorrect in the context of modern complex systems. The problems we are solving are too large, too complex, and too data-intensive for any single mind to handle. No one person can master the mathematics, the computer science, the data engineering, and the market microstructure all at once. The billionaire behavior is the humility to recognize the limits of individual genius and the wisdom to build a collective systematic intelligence. When I built my firm, I did not hire people from Wall Street. I hired mathematicians, physicists, signal processing experts, and computer scientists. I hired people who had never traded a stock in their lives. Why? Because I was not looking for people who were experts in the narrative of the market. I was looking for people who were experts in the structure of the world. I wanted people who could look at the market as a pure abstract problem. In applied mathematics, the team is fundamentally interdisciplinary. A pure mathematician brings the theoretical rigor to design the model's core logic. A computer scientist brings the engineering expertise to handle the massive data sets and execute the trades at speed. A physicist trained in modeling chaotic systems brings a unique perspective on market dynamics that a traditional finance person would miss. This diversity of thought is not a luxury, it is a necessity. It prevents the team from developing a single collective blind spot. If everyone thinks the same way, they will all fail the same way. The culture of the team is everything. It must be a culture of pure unadulterated logic. In our meetings, there is no hierarchy of opinion. The newest PhD student's model is given the same weight as the most senior partners, provided the data supports it. The only authority is the evidence. If your model is wrong, you do not defend it with your ego. You dismantle it with your logic, and you learn from the failure. This is a behavior that most people wouldn't believe because it is the antithesis of the typical corporate environment, which is often driven by personality, politics, and seniority. We created an environment where the only thing that matters is the signal. We treat every idea as a hypothesis to be tested, not a belief to be defended. The failure of a model is not a personal failure. It is a data point, a valuable piece of information that tells us where the pattern has broken down and where we need to focus our next effort. This removal of ego from the process is what allows for continuous rapid improvement. The team's structure allows for a constant systematic search for new patterns. One person might be working on a model for currency fluctuations, another on commodity pricing, and a third on the subtle movements of bond yields. Each model is a small piece of the puzzle, and the collective system integrates all of these small edges into a single cohesive strategy. The whole is far greater than the sum of its parts. The analogy is a complex machine like a supercomputer. No single transistor is responsible for the computation. It is the architecture, the way the millions of components are connected and work together, that creates the intelligence. Our team is the architecture. We are a collective intelligence, a system of minds working in concert, each specializing in a small critical piece of the overall problem. The billionaire behavior is the willingness to surrender the spotlight to the system. It is the understanding that the greatest success is achieved not by being the smartest person in the room, but by building the smartest system in the room. It is a shift from the cult of personality to the cult of process. It is the ultimate act of intellectual humility which paradoxically leads to the greatest success. We have explored 5 behaviors that, while simple in concept, are profoundly difficult for most people to adopt. They are the rejection of intuition, the relentless pursuit of small edges, the elimination of emotion, the decoding of unseen patterns, and the power of a scientific team. These are not just investment strategies, they are a mindset for life. They are about replacing the unreliable narrative-driven human mind with a systematic data-driven approach. They are about understanding that success is not a matter of luck or genius, but a mathematical consequence of a superior process. The moment you stop trying to be a hero and start trying to be a system, you begin to unlock the true potential of your own logic. If you found value in decoding this mindset, I ask you to do 2 things. First, like this video to help us share this logical approach with more people. Second, In the comments below, write one sentence about how you will apply the main lesson, the commitment to a systematic, unemotional process, to one area of your life this week. The world is governed by patterns. Your success is simply a matter of whether you choose to observe them with logic or ignore them with feeling.